Mm, Good evening, everyone. Let me just confirm if all our speakers are here.
Good evening, Amit Halima. Nice to see you. Good evening, everyone. Just wanted to confirm that my microphone is audible.
Good evening, Mr. Kevin. Nice to see you again. Happy New
Nice
Year.
to see you too. Happy New Year. Happy New Year to
Good
you
evening,
too.
everyone. Just
Nice to
wanted
see
to
you
confirm
too.
that microphone is audible.
Yeah, Mr. Kevin. Nice to see you again. You are audible.
Happy New Year. Nice to see you too. Happy New Year. Happy New Year to you too. Everyone. Just wanted to confirm that microphone is audible.
Yeah, Mr. Kevin. Nice to see you again. You are audible.
Happy Nice to see you too. Happy New Year. Happy New Year to you too. Everyone. Just wanted to confirm that microphone is audible.
Yeah, Mr. Kevin. Nice to see you again.
There's a bit of echo.
Yeah, it's echoing.
Yeah, it has been sorted.
Okay, before I begin, we're just waiting for one of our speaker, Leila, which will be joining us very shortly.
Harry, I'm here.
Oh, thank you. Okay, I'm gonna begin now. Because your camera is not switched on, that's why. If you can switch on your camera, it will be so much.
I need a minute. I'm trying to see where I can park and go inside the office. I was out.
Oh, okay, that's fine. All right. Well, good evening, distinguished speakers and our audience. Welcome to another edition of Africa Real Estate and Business Insight. Thank you for joining us today. My name is Halima Aliyu. I'll be opening today's session before handing over to our host. This seminar, as usual, is organized by African Real Estate and Business Insight, where we are committed to advancing real estate and promoting sustainable, inclusive development that support long-term economic and social growth across the African continent. Our theme for today is Who Pays, Who Benefits, Structuring Capital for Social and Economic Infrastructure. This seminar will run for 1 hour, 15 minutes, which followed by the main discussion. And please, our audience, if you have any questions, please just put in the chat box, which will be attended to at the end of the seminar. And I would like to hand over to our host in the name of AS Yunusa, who will guide us through the rest of the program and also introduce our distinguished speakers from South Africa, Kenya, and Uganda. Thank you, and over to you.
Thank you very much, Halima. Good evening from here, anyone, and good afternoon, depending on the country you are joining from. It's a pleasure to meet again face to face. Mr. Kevin, thank you for always showing up. Leila, thank you also very much. And my brother from South Africa, welcome to African Real Estate and Business Insights.
Welcome.
Thank you. Last month, we have a robust discussion on looking beyond building and considering social infrastructure across Africa. And we are happy to feature people in development space in that conversation. Today, we are going to look at African infrastructure, who benefits and who pays. African infrastructure conversation is often framed as a financing gap. When what we hear when we talk about African infrastructure is about $100 billion that is requested annually in terms of infrastructure deficit. But the deeper question is not how much capital we have on ground. The real question should be, how is that capital structured? If any is available, who carries the risk of these capitals, and who captures the value, who is benefiting from it, and who ultimately pay dearly or who bear the cost? Because we have seen that across African continent, we have seen that power purchase agreements that have been secured, but at the end of the day, it strained national capitals. Or we have seen urban infrastructure that was publicly financed, but tied down national capitals in terms of allocation to other social requirements. So our today's conversation is not just about the money, it's about incentive design, risk allocation, governance, architecture, political economy, and structural alignment all together. I'm going to introduce the amazing people I have with me. Some of you that have been coming on this conversation, you are familiar with most of them, but that is me. I'm going to read their bio before we take the conversation proper. The first person is Mr. Vuyani Bekwa. Do I pronounce the name right? Mr.
Yes,
Vuyani?
you have. Yes,
Thank you very much. Mr. Vuyani is a principal at private equity MSM Property Fund. He is an experienced real estate and investment executive with deep expertise across private equity, fund management, asset management, property, and renewable energy investments. Wow. He currently serves as principal private equity at MSM Property Fund, where he focuses on capital allocation and strategic investment structuring. Previously, he was a portfolio manager at Investic Asset Management, which is now called 91, where he managed approximately $670 million in assets under his management. And he also served as fund manager for over $1.9 billion Liberty Property portfolio. Money is talking. So that is a rich introduction of Mr. Vuyani. Then I have Laila as well. She is known as a woman of investment in her LinkedIn. We have been there for quite some time. Miss Laila is the founder and chief executive officer of Muta Investment Firm, a Pan-African investment company, and she also specialized in project facilitation platform, connecting investors to high growth opportunities across East and West African countries. She specialized in structuring, funding, and supporting projects across real estate, infrastructure, healthcare, mining, industrial development, tourism, and agri-businesses. And Leila, you have to employ me. Her firm also worked under structured mandate with government and private sector to facilitate investment, trading, and project execution. Her platform has connected over 8,000 investors and developers. And the final panelist we have today is the managing director of Auric Advisors, who is Mr. Kevin Sanya. Mr. Kevin Sanya has over 8 years of experience in real estate development and investment across Kenya and other sub-Saharan African markets. He is a Swedish Institute scholar and is currently pursuing his master's in urban studies, specializing in real estate and transport at Malmö University in Sweden. He has led initiatives spanning property management, business development, and stakeholder engagement by working with both government and private players. So my rich CV panelists, you are welcome to today's African Real Estate and Business Insight Forum. Please, our audience, if your hands are not tired, kindly give them a round of applause by indicating your favorite emoji. So now we are going deep into the conversation. Who pays and who benefits? I think I'm going to start I'm going to start with you, Mr. Vuyani. I'm going to start with you, Mr. Vuyani, with your rich expertise in capital funding and allocation. So in many cities, many African cities, urban highways are majorly financed through public borrowing. But yet, these projects, once they are delivered, they normally increase land values for private developers. Properties in such locations experience high appreciation. In some cases as well, electricity tariff, they rise for citizens in order for government to be able to service the debt that they collected in putting these infrastructures in place. So my question is to you is, where do we see the biggest mismatch between who pays for Africa infrastructure and who ultimately benefit from it? Mr. Vuyani, thank you. Over to you.
You're putting me on the spot on this one, eh? Maybe let me think. For instance, in South Africa, I mean, we've had load shedding over the past, let's say, 10 years, and Eskom went to market around how can the private sector assist in terms of, one, reducing that shortfall in terms of how much electricity it provides, and the second one is how can the private sector develop own not power stations, but electrical sources of power supply in order to feed into the grid, so that it assists Eskom as a national supply of electricity in order to again reduce not reduce supply, but provide more electricity. What's happened recently is that, I mean, when the initial bidding process, for instance, with the solar PV, when it went to market on the Renewable Energy International Procurement series or program, it highlighted, it sort of gave incentives to international investors, because what it wanted to do was basically draw international investors into the country. As a country, we never really focused on solar, large-scale solar production. That was always something out of the UK, out of the US, out of Germany, out of the East. So all those projects, I think, when they came, when those international entities came through and partnered with local entities, they basically had to create an incentive. So that incentive basically, especially in that first bidding process, I think the benefit were the international companies, as I said, because of the incentive that was given for them to be able to want to invest into the country. On But what we've seen is that in subsequent programs, I mean, we've had about six rounds of bidding rounds. The tariffs basically have come down as the local market has now started to participate. So I think that initial bidding process basically has benefited international companies rather than local companies, and we think it was, that was sufficient at that point in time in order for international companies to come through and provide what was necessary at that point in time. I'm not sure whether I've answered that question sufficiently or not.
Yeah, thank you very much. You have provided a sufficient response to the question, in fact, by bringing from your experience in your country. I think that is what we encourage, relatable responses. Thank you very much for that response. I'll still come back to you. So
no, happy with that. Happy with that.
Leila, I don't know if you have settled down. If you have not settled down, let me reach out to Mr. Kelvin.
Yeah, please, Mr. Kevin, I think it's
okay, let me reach out to Mr.
Just
Kevin.
a minute.
Okay. Mr. Kevin, across African countries, we have seen sovereign guarantees issued for big capital projects, like power plants in some countries. Even toll roads, which we call toll gates in our country here, and also government normally absorb part of this pain in terms of exchange rate risk. So when local currency depreciates sharply, it puts burden in the government. So we have seen some projects in countries like Ghana, Kenya, even Nigeria here, a power project in the state we call Edo State. So meanwhile, private investors, they often structure their exit early. They benefit from this project, they exit, and they leave government with long-term liabilities. So my question to you is, in most African infrastructure projects that you know, who is currently carrying the most risk? And can you say those allocations are sustainable as well?
Hi, Lisa. Can you hear me? Hello?
Yes, I can hear you. You can go ahead.
Okay. I think I'll just pick it up from where my colleague stopped from, and I think the question is really relatable also in the Kenyan context. Like if you look at the similar PPPs that you find in say South Africa or Uganda, you would also similarly find them in Kenya. While also just thinking around, I also encountered the Gautrain project, which similar, we have an SGR project in Kenya, and also in Uganda there are express highways where they have different financing models. But I think the biggest mismatch between infrastructure finance is that, like the title for the webinar today is that the people who actually pay upfront is not actually the people who end up benefiting from. So, for instance, I will just talk about the Kenyan the Kenyan sector, which I'm a bit familiar with. If you look at the public sector in Kenya, it carries the biggest risks in terms of these projects, in terms of going out to seek for sovereign funds and to seek for euro bonds and all sorts of financing models that they bring on board. The public sector carries that financial risk through the public budgets. And then also now when you're looking at deployment of the projects themselves. You're looking at things like land approvals, guarantees, and other forms of state support. And at the end of the day, the citizens often feel the cost again through taxes and tolls and tariffs that come at the end of the project once that project has been rolled out. But you see, some of these benefits are usually much wider than concentrated in one place or where the project in itself was initiated. So you look at benefits usually much wider. They are often concentrated in places the financing model does not fully capture. So for instance, like you said earlier, people like landlords who are near, for instance, who are near the exit ports of a train project, for instance, or who are near the exit points of expressways, they get the maximum benefit. People like developers, businesses, and other people, other initiatives around those urban corridors, they get the maximum benefit, but the cost is sort of shared by the entire population that pays through tariffs, taxes, and tolls. Another good example, I think, also that we find in Kenya is housing development, and the Kenya Affordable Housing Program has repeatedly structured housing units plus associated infrastructure and social infrastructure, not just as buildings in isolation. So if you look at the official documents from the government, of course, the Ministry of Housing and Infrastructure, you will find projects like those who are familiar with Kenya. There's one in Nairobi that is called Starehe, which was a design, build, and finance and sale of housing units and associated infrastructure. So you find this was a flagship project that was producing almost 2,000 housing units that would entirely, in the end, supposed to benefit the common man. So it's very important. That was a very important project for the government to finance land acquisition, trunk infrastructure, because these are the places, some of these places do not have proper infrastructure, such as sewer, planning support, and enabling policy to also enable ownership at the end of those projects. So this value is created, not limited to just the housing buyers alone, the people who end up buying those units, but then you also find that the people who would end up also benefiting are the neighbors and the landlords and the businesses that are around there, which improves the urban form and also can unlock future private investment nearby. So like I said earlier, I think public support helps to create that value, but the gains are not always captured in a way that recycles back into more housing or more infrastructure. So I think the real question for this discussion, maybe as we are starting, is how do we then fund this infrastructure? It's not just how do we fund this infrastructure, how do we also make sure that those benefits help sustain it? So in Kenya, at least, that points us towards stronger land value capture, better use of development charges, maybe smart cross subsidies, and more deliberate efforts to connect infrastructure finance to the value that it creates in real estate and urban development. Yeah. So I think that would be my response to your question, Yunusa, and also just trying to link up to the earlier response.
Okay, thank you very much, Mr. Kevin. You spoke a lot, talking about the taxes, the tolls, and also the incentives that will need to be put in place, and also massive infrastructure that is taking advantage of urban scaling. So thank you very much for that insightful response. As I said, I love how the session is being relative, speaking from experience. That's what we're looking for. So Leila, are you ready for me now?
Yes, I'm ready.
Oh, okay. Thank you very much. Okay. This is the build up to your question so that you know how you will give me. Well, we have seen over time blended finance models that are being deployed in renewable energy through development finance institutions. We have also seen toll gate concessions, infrastructural bond, and sovereign wealth funds participations in massive projects in Africa. Yet, some of these PPP projects, they have collapsed under unrealistic projections. So my question now is, what capital structure have actually worked in aligning public interest with private returns in Africa?
No, thank you so much for that question. Mostly, we are starting to ask ourselves mainly, where is that capital? Is it coming from? We do have a lot of funding, but also the other question would be, who is structuring the funding and what are the terms of those funding in the first place? And most of the time, we find the problem that we're having. It's mainly the only way to have funding for those projects, they have to be a guarantee of that money. And most of the time when such a thing happens, the person who is funding the project is the one in charge. The person with the money is the one who is in charge of the negotiation. So you can never sit down and say that negotiations are going to be 50-50 when you need the money. So most of that time you find that actually a lot of countries, they are giving out the guarantees, such as mining, the mining sectors, they're giving out the gold mine, they're giving out something else in return to get the money. Then after that, even that guarantee, that money has to come with interest. So the structure way, for me, I do believe that also we have to start by saying, what does African want in the future? Because if you are thinking about now we are going to make sure to get more money from different people, but we're not thinking about the consequences, because right now we are hungry for the money. So the issue is, it should be, how do we structure that funding in order for both sides to benefit from it? Because right now, the structure we have right now, mainly the people with the money, they're the one who are benefiting more than the people who are asking for the money. So the structure way, and for me, I do believe right now we need to understand how best we can first learn ways of asking for less capital, because we can provide for ourselves capital. Then secondly, how can we structure the best partnership between the person who owns the money instead of taking advantage of us? So there are many questions. It will be a long time to explain everything at once, but bestly, the countries has to think about how best they can create the investors earning on the return, but while also thinking about themselves as a country. That will help in both benefits. I let me hope I've answered your question as.
Yeah, Leila, thank you very much. You give us a challenge. The problem is not the fund, is how the fund is being structured.
Maybe I can add something onto that.
Yes, from institutional capital perspective, Mr. Vuyani, before I move to your next question, I want you to also speak from this point, judging from your volume of experience in regards to that.
Thank you. I think probably maybe I'm also jumping ahead now in terms of where we should be sourcing the funding if that's an opportunity. I think if a lot of the African countries can source the capital internally or inside the country, then the mismatch between currencies, one is eliminated, and also because I mean, if now, for instance, if a company in Europe or out of Saudi Arabia offers funding opportunity into Africa, they're gonna have to ensure that if, for instance, they're lending in dollars, they hedge that dollar risk or currency risk, Then they're going to make sure that they look at inflation inside the country. There's a lot of hedging that needs to be done from their perspective to ensure that they also their funds they can get the returns that they've envisaged or modeled over, let's say, the 15 to 20 or 30 year period. So I think what we need to do is to ensure that our own investment or fund management industry or asset management industries can use the pension funds inside the country. If there is a pension fund industry, I know that a lot of African countries, I think, have put that in place, at least by now. So that's very important, that we don't always go outside the country to try and fund infrastructure projects.
Okay. Okay, thank you very much for that, your contribution. I actually want you to contribute because your CV was high on that aspect of capital structuring. But your question now is this, Mr. Buyani, if you can still hear me.
Yeah.
Across the African continent, we have witnessed rising debt to GDP ratios. Government renegotiate agreements they first had with investors. In fact, sometimes some of these projects also face public resistance, and infrastructural assets operating below the capacity at which they are projected. In some cases, opaque contracts also lead to political backlash and call for investigation by citizens. The main question now is, how do poorly structured projects show up later as debt stress, service failure, or social backlash? Thank you.
Good point. Actually, in South Africa, there has been one that has really had a negative impact. The government has reduced I think some time ago, the user pay principle. Our government, has had its challenges around corruption, etc. So when these infrastructure projects are put into place, there's always some skepticism around whether the project, or there was some political related persons are not benefiting out of that project. So that's a sort of first comment. Second comment is that the structuring itself, again, I come back to the comment around being internally funded within the country itself, because that element of being exposed, of having the international exposure, does bring a lot of negative assumptions within the country itself to say, is there somebody benefiting in US dollars out of Switzerland, out of wherever? So that's my second point. We've seen, as I said, one of the toll road projects within Gauteng, where the main beneficiaries were outside of the country. The national government ended up having to step in and repay the debt based on that, because the communities or the users of the toll road were not happy with the structure of the transaction itself, and secondly, the tariffs that they end up having to pay, because it was not contributing to economic growth within the geography. That meant that you're almost like seeing a double taxation now, where you are contributing to government through your income taxes, and value-added tax, and now the tariffs that you're incurring on a daily basis, they again getting too expensive in order for them to, and really impacting your net income.
Thank you very much, Mr. Vuyani. As I said earlier, I love the relatability in the response you are giving us. So, Mr. Kevin, before your second question, there's one question I actually want you to speak about, because I know you major on sustainability, which is the first question I asked Mr. Vuyani in the first place. If you can, I'll repeat the question again so that you can throw your own insight on it before I give you a second question. I said in many cities, African cities, we have urban highways, government projects that are being financed through public funds, and these funds, these projects, once they are executed, they increase value for private developers or even private landowners. And also, when government is trying to pay back most of this fund that they borrowed, they collected, they come back to tax the citizen by increasing tariffs and the like. So where do you see the biggest mismatch between who pays for infrastructure and who ultimately benefits from it? Before I want you to make a contribution in regards to this question.
Yeah, thank you, Ines. I think I based my first response majorly on this as well, but I will just try and reiterate the same. I think the biggest mismatch in infrastructure finance is that the people who pay are not also most often the same people that capture the full value over time, like we have seen in many projects in Kenya, and I know it's very relatable also in South Africa and Uganda. So like for instance, in Kenya, the public sector still carries a large share of infrastructure risk through public budgets, land approvals, guarantees, and other forms of state support. And still, the citizens often feel the cost again through taxes, tariffs, and tolls, like I intimated earlier. But the benefits are usually much wider and often more concentrated in places the financing model does not fully capture. So you look at external people like landowners who are around the projects, be it a railway line, be it an expressway, or a housing development that has been funded by the government. So you find people like landowners, developers, businesses, and the whole really urban corridors, they become more productive because of that specific infrastructure that exists. I think I mentioned earlier also about one of our biggest infrastructure projects that was at one point very politicized, but also after a couple of years, almost 10 years now down the line, the public has started experiencing the benefits and the outlier effects also of the project. I think most of you are familiar with those who've been in Nairobi, the Nairobi Expressway. It was built under a PPP structure, and according to our roads authority, it was a very key corridor when they were launching it, because many people were asking, who will it benefit? We are getting a concessional loan of close to 30 years, and we'll be paying for this for 30 years, but who will it benefit in these 30 years? But then they came in and really pushed for it, because they thought it would really help in moving cargo and moving people from one point of the city to the other. So that tells us immediately that really the value of that project goes far beyond the motorists paying the toll fees, and the beneficiaries also will go beyond just the people who will be using the road, but also freight companies and logistics operators and farms that depend on reliable movement of goods within Nairobi and the metropolitan areas. So the same also we have seen, because my background is also in real estate. So you'd find the same also apply in real estate investments. So for instance, the project I mentioned earlier, the Stare development, which was a design, build and finance and sell out housing units. It was a flagship project that would essentially, the primary goal was to house close to 2,000 households who currently are either renting or living in shanties. So that was the primary goal. So that's important because the government in this specific project, through the financing model, provided land, trunk infrastructure, planning support, and enabling policy. So the value created was not only limited to these 2,000 households that will be coming to live there, but also the outlier benefits that really spill over to the neighborhood. So there's also that long-term value of the surrounding neighbors, improved urban form. It also unlocks potential for future private investments nearby, and also public support helps create that the value. But the gains are not always captured in ways that we also look back and recycle back into more housing or more infrastructure. So it can be something that is also greater than just people owning homes, or it can also be greater than just people who are using the roads themselves and paying that tariff. So there's that spillover effect.
Okay, thank you very much. I love the session we have been having since January, because we are talking about the parts of the real estate that concern the general public. Now, the main second question I'll give you this question and immediately just brief response. Then I also want Leila to provide response to this question immediately after you. Please, this one is dear to me because a recent report pointed to that. So this one is across African countries. If you see most of our interests, we focus on large-scale projects. When we talk about infrastructure, we talk about highway, we talk about ports, we talk about railways, even power and energy. But some of the most critical infrastructural gaps are at the household level, like many social infrastructure projects like housing, hospital, water system. They struggle because returns are long-term and not immediate. So it's deprive institutional investors from looking at this end. Let me give you a typical example before I ask the question. Recently, the UNICEF reports that Nigeria has the second highest rate of open defecation globally. They say that to close this gap, that Nigeria needs 10 million toilets, which they state that the 10 million toilet represents an untapped market of roughly $1 billion. So we can see that the demand is high in this regard, but the capital structure to fund this kind of project is broken. So my question now is, how should Africa rethink its capital structure? Talking about grants, concession finance, equity debt, to make social infrastructure projects bankable without overburdening government. How do you think we can achieve this without putting the main burden on the government? Kelvin first, then Leila second.
Sorry, come again with that last bit of the question.
Okay, the question is, how should Africa rethink its capital structure to make social infrastructure projects bankable without overburdening government participation?
I think if you want to attract long-term investments and also not overburden the common, in Kenya we usually call common mwananchi, which means the common citizen. I think we've got to think really deep. think of the person who's giving the funds. We need to think like we need to think of different institutions that can give funds, because majorly governments just always go for loans because we understand how pricing of those loans are and who benefits when those loans are paid. But there are other areas that we can look at, and like my colleague Ali has indicated, if we look internally, then we are able to really save a lot. For instance, in Kenya, we have a huge and massive pension fund, that insurance that hold. And these funds can be deployed for as patient capital in some of these major infrastructures in the country, and it will, because the return on the pension also goes to the general citizenry. So it does not go out of the country, because when you get a loan from different institutions, multilateral institutions, then that money goes out of the country. But when we use the pension, then the interest goes back to the people who are contributing the pensions, and they're also benefiting from the infrastructures that have been done. So I think what we need is a lot of predictability, and if we are looking at sourcing for these funds internally, then we can model predictability. But if it's funds priced on the US dollar or funds now priced in the Chinese currency, then the predictability there can be a bit of an issue whenever there are wars or there are currency fluctuations. The other bit I think we also need to focus on is transparency, and also just looking at the risk. So I think that would be my very short response to that. Let us look internally. Let us look for patient capital that we have internally, and also in terms of modeling projects. Then there's a lot that we need to do, both as private investors and working together with government to ensure that the projects are really transparent, and the end users who are supposed to benefit from these projects are clear, and even the spillover effect is clearly communicated even on the onset.
Thank you very much, Mr. Kevin. Leila, the same question over to you. Should I repeat it, or you get it clearly?
Yes. You can go ahead and repeat it. That's okay.
Okay. As I said, the question means dearly to me, because UNICEF made a recent report that we have 10 million toilet deficits in Nigeria. So the main question is that how should we rethink our capital structure to make social infrastructure projects bankable without overburdening government? There are social infrastructure that are needed. How can we make them bankable so that we will not burden the government, and the project will also attract investors to take advantage of them?
Yes, thank you so much. So one thing I should say is that first, African people, we need to change our mindset when it comes to the working and also business side. And I think most of the challenges that we have is that we find a lot of African people and African countries, they want to own things. They want to be I want to own the house. I want to be the one owning that project. That divide us to think into partnership way. So for me, I would say one thing is that a lot of projects, they should be start by partnering each other. If, for example, I have a land in a good location, why can't I think about partnering with someone with a capital? My friends, that's with my friends. So we can build something big. But that will be, but some of the challenges, of course, you find is that I rather own the house, I rather own the land, I also own the house. And you find that the fact that I don't even have enough money, the building structure or the plan of the structure of that house is going to be probably less attractive or less thinkable, because of, I'm thinking in terms of my capacity of my work, or even because I can't afford it. Instead of working with a friend, I rather go and ask for a loan. So for me, I would think we need to change our mindset on how we can come together to make sure we start partnering with some of the project that needs the partnership between us. Then secondly, also, I would think of for the bankable, the banks and all that. You find that the reason why we go out to outsource the funding in first place is because the interest rate right now in Africa are the most highest interest rate worldwide. And it's sadness to find that I have to pay more than 17% on interest to when. So I think also when it comes to banking, I'm mostly, I don't have much knowledge about banking side, but when you look at the banking, the way they have structured it, they are showing us we need them more than they need us. So that means they can easily say tomorrow, my interest rate is 20%. So government needs to put a structure to make sure people who are entrepreneurs, people who are doing business every day, at least they have a talk in negotiations of the terms of those loans. The reason why we go outside to Chinese, to Indians, to outside in UK to outsource loans, it's because our high interest, the high interest is too high to the extent that you can't really work with it. So we need to think, and then we have to structure, and then we'll create the terms for every structure that you are building. Then third, which is, I think, is the most thing we need to think about mostly, is to think that the government needs to think through, because right now, most of the time, I've seen it, especially in Uganda, one, you build something today, then tomorrow, it's called KCCA, it's in charge of the housing and all that. They tell you that, oh, actually, we have another plan for this land. So we need also the cities to first also structure, give us an ideology of where the city is heading, because a lot of people and a lot of structuring is working out of terms because they don't understand where the country is heading. They don't understand where the city is heading. So first of all, let's also build where, to make it easier for people who are doing those projects to understand what they're going to do in the future. It's easier for me maybe to go and invest in Rwanda, because immediately I go there, they will tell me 50 years project plan of where they're heading. So mostly also we need to create the terms and structure on how we can, first of all, make it easy for an investor and all for investors who are inside the country. But second, also we need to change the mindset on how we can partner together, both of us inside, but also mainly also I think we make it easier for someone to access loans. Let's reduce those interests. I understand we all want to make money, but let's not exaggerate. Then lastly, I will mainly say that there is a lot of projects also that you find that a lot of people in Africa, they can do. But because we don't believe in ourselves and in us, you find they rather give that project to a Chinese than and someone inside Nigeria doing it, because mainly we think they're doing better than that, but also mainly because also there's a lot of corruption and other things. So we need also to make sure we believe in ourselves, but also build the terms and structures that makes us believe in ourselves.
Leila, thank you very much for that. You have spoke from a very fundamental point, looking into our mindset, which is number one. If we can't change our thinking, we can't change anything. And secondly, you talk about looking at the banks, let them reduce the interest rate for us. You are talking about 17. In my country presently, it is over 28 because our MPR is 26.5. Then you also talk about zoning, looking at where development is heading to. So thank you very much. Mr. Kevin, your hand is up. Do you want to make any contribution, or is just a mistake?
Yeah, just something to add onto that. I think that came into my mind. I think it's also a pickup from one of the webinars that we had before, the blended financing structure that I think is currently picking up in many real estate projects in Kenya, and I think there are also some projects in South Africa. It's one of those structures that is also bringing affordability into big infrastructure projects. So yeah, I just wanted to add on to that as an additional capital structure.
Thank you very much. The conversation is getting interesting. As we are moving up onto the final wrap, anybody that have questions, you can quickly drop a question because our time is fast spent and we'll be rounding up shortly. So on final notes, this one is general final notes. The theme of today is about how we can restructure our social capital for infrastructural development. So on our final notes, let me just leave it to you. What do you want us to go home with? Starting from you, Mr. Munya, then Leila, then Kevin. What's your final note to us on this section?
Maybe let me just add on to, I think, the last question in terms of capital stack and structure. I mean, governments are supposed to basically be the ones providing infrastructure, firstly. However, we've seen PPPs working. I mean, in order not to overburden the government, one needs to bring the private sector. But you need to bring it in such a way that I mean, that's one ways of, if you remember what the formula for economic growth, C plus I plus G, which means that private sector has got to be involved there's got to be private sector involvement, or you're going to be crowding out private sector. Therefore, it means that government cannot be the only one that is contributing to economic growth. So PPPs, as long as they're structured properly, I think Leila and Kevin have spoken about those as well. As long as they're structured properly, I mean, also Kevin has just mentioned blended finance, which is now basically being used to try and reduce the cost of capital for all these projects, because you basically blend equity and debt, and then at least the cost of capital if you provide a structured product, at least the cost of capital reduces. Remember, we talk about 15 to 30 years in most cases, and longer in rare cases. So as a final point, I mean, look at blended finance from a capital structuring point of view. Introduce the private sector. They must carry some of the can as well. They must look. I mean, they could even extend, for instance, the PPP from, let's say, 15 between 15 and 30 years to even 50 years, in order for them to get that additional benefit that they need. And of course, the government has to come to the party in terms of providing guarantees. Unfortunately, that one we can't run away unless the government is well managed. There aren't any. There's no sort of sense of corruption within the government itself. Government has to provide some sort of guarantees. That's something that we can't. I think as investors, you don't necessarily want to run away from, because that cash flow could disappear, and we've put in huge capital investments without getting any return. Without getting any return. I think that's my last contribution.
Okay, thank you very much. You give us some points on your final contribution: blended finance, bringing private sector in place, and government cannot be left out. They should come as a guarantor. Thank you very much. Leila, your final note, please.
Yes, I would say mainly also it's government to structure the terms of private sector. How do they come in, and what are they going to do? They make it clear for the private sector to understand why. And mostly also is to believe in themselves, to believe that the private sector, it holds a lot of importance in this country. Without private sector, the government sector really, let's be honest, in a capitalism session that we are in right now, private sector is so needed as much as government sector is. So that's one. Then secondly, it's to be the government to learn to negotiate. Let's not continue these games that we have been playing where our individuals, our leaders want to benefit in long term. But this infrastructure, if the quicker they move, the easier that it helps the country, but also both sides on private sector. So the more we can learn how to sit down and negotiate, these are the terms, these are what we want. If the project is going to work in, it's 15 years. 15 years doesn't mean 30 years. And also we give people the private sector also to have some of the mandates inside, to have the partnership in some things. Because when you look at it, you find that government rather work with outsiders than working within private sector. So that mindset has to change. Then mainly also, I do believe that in terms of the terms and also negotiations and also the guarantees, I do believe I've seen it many times, especially in West Africa right now. I'm more involved in Guinea. You'll find that a contractor rather delay the project because they're benefiting in gold mine more than the project. So on those terms on how they're going to use the guarantees, remember they're also paying the interest on that money. So they have to also sit down and revise. You find that people give out the contract and that's all. They don't go back to know how far, how is it going. So I think some of the things that are being challenged is that sometimes we're also lazy and we're killing ourselves. So we need to stop being lazy on some of for our goodness, because we need Africa to grow, and we can't be less and we expect it to grow as fast as we want it. And then lastly, I would say mainly also in terms of infrastructure and structures and real estate, you find that you know how much I love real estate, so and it's your industry. That issue that you find that a lot of people are not benefiting is because a lot of also investors who are investing in real estate or private sector, which is developing these real estates and infrastructure, they are overthinking more of luxury. They are thinking in terms of right now, you find they want to be Dubai immediately, which means if they are building infrastructure or a real estate or commercial real estate, that is so luxury and they spend a lot of money, they expect people now to rent it or buy it on high interest, which is going to be a problem, because right now when you look at how the salaries that people who can afford those houses, I think they also need to sit down and do advisable work to understand who are we building for, and can he afford it? Which terms can we easily make? Because right now it's easy to buy a real estate in Dubai at 2% of the money. How can we structure the good terms for someone to affordable? Instead of asking for a loan, we can give them a structure ways where they can pay that money and they don't have to break their back. So they also need to focus more on the terms and the structure on both sides. But for me, I'm still excited to when I'm on the ground every day, traveling, seeing how Africa is growing. I'm glad and I'm happy to see where it is going. Thank you.
Thank you very much. We are all excited about our continent and we want it to grow. I love some of the points you made here. We are developing country and we should not be lazy. Everybody should come out when the blood is high. Thank you very much for that. You also reinforced that the private sector is needed in this fight. I mean, I look at it as a fight. Then most importantly for me, because there was a conference I attended yesterday, they also said the same thing. The mismatch in development with the purchasing power. People focusing on luxury, but what is the purchasing power of the market we are building for? So Leila, thank you very much. Kevin, you on your final note, please.
Thank you so much, Yunus. I would just like to ride on to what Leila and what Vuyani has said. I think Vuyani mentioned about we got to be optimistic that our governments will not be corrupt. And I think that's a big optimism that we really need to push. And I agree with Leila as well that as private players, we've got to stop being lazy and try and push these numbers down and not just think about the bottom line. So I think for me, my closing remarks would be, I think the starting point, we need to start by recognizing that social infrastructure is often high impact, but not naturally high cash flow. You don't get the best money out of social infrastructure projects. And that includes affordable housing, schools, clinics. You talked about toilets, urban services. So if we try to fund them entirely with commercial debt, we usually create stress either from households or for investors or even for the government itself. So the solution is not simply just the money; it is the right layers of money in the right order. So I think what I would suggest in terms of these layers of money is the first layer definitely is what we know of, like grants and public funds for the initial stages of the project. So things like feasibility studies, legal structuring, environmental and social work, impact assessments, and basically just site servicing. I think this is where most projects live or die, and it is consistently underfunded. And if we entirely just depend on private funds and I think it's important because it reduces the cost. So if you're looking at blended finance, for instance, created over the long term rather than captured immediately in the cash flows. So if you're looking at big infrastructure projects, or if you're looking at housing development for the low income part or bracket of the population, I think concessional finance is important. And I think thirdly, which is the third layer, is risk mitigation. So we should be looking at guarantees. We should be looking at insurances. We should be looking at credit enhancement tools that reduce political demand and currency risk. I think we also discussed such tools in a previous webinar that is specifically in the real estate sector. So this layer is then often helps crowd in investors who would otherwise stay out. So I think my parting shot is that governments should try to really should not try to bear everything directly on its balance sheet. I think its role should be to use public funds strategically. And like I mentioned at the inception parts of the project, to just prepare projects well, to lower the risks where necessary, to support affordability transparently, and then to crowd in now capital that can now come in and stay in long term. There are so many investors who would like to invest in real estate. There are so many investors who would like to invest in roads. But the initial cost, which has very little cash in return, makes them shy away. So if government just comes in and takes care of that, because government owns all the land, government is they actually the ones that make the laws. So if they make it favorable for patient capital to come in, then that's a conversation that many institutional investors and even pension funds and insurance companies can come in and fund projects locally. So the goal is not just to attract private money. It's to assemble a capital stock that really reflects the economics of the project and really protects the public interests at the same time.
The conversation is interesting for everybody. Thank you very much, Mr. Kevin. You spoke a lot, and most importantly, risk mitigation. For me, I picked that very well because we must consider the risk so that in trying to provide social infrastructure, the decision should not suffer for that. And also, you said we should look at social infrastructure as an impact project, because when we look at it from investors' perspective, we'll be motivated in going into that. Leila, you want to make contribution? I can see your hand, so the floor is yours now.
Oh, thank you. So I wanted to say that on what Kevin said, that a lot of infrastructures or those projects, you find that they're not profitable, and that's why investors are not always hungry to go inside or to capture that side. But recently, since October, I've been in Kigali learning about the heart transplant and all that, because I'm trying to help Guinea to build a better future of Guinea. So there's one thing that interesting that His Excellency was saying, that 60% of infrastructure, when it comes to human infrastructures, those are schools, those are toilets, as you said, the houses, free housing for the people can afford it, and all those things that really people needed. You find that those infrastructures have been made by prisoners and other people who can work. So I think also that the government also structuring some ways for people to do things for themselves without depending on outsourcing and all that. That will be helpful, because so far I've seen a lot of schools here that have been built by prisoners. Houses have been built by prisoners. Military has been built but for themselves, including prisoners. So some of the things really don't need capital. They need us to go there and help ourselves. And other things, of course, they need capital, where we need also to match internal private sector to work with outsourcing. I'll give you a simple example. The guarantee of Ghana recently, they have a road that they're going to build. And I managed to make sure one of the investors called Shane, that they're structuring easy way to build roads which can last long. But the only way we could work with Shane was to make sure that he partnered with the local partner, which went well, and right now they're doing well, and the business is moving forward. So for me, I do believe that everything that we're working in, let's think, okay, what can we do for ourselves, and how, even if we're outsourcing, how do we let the private sector, their own people, benefit from whatever we are doing? Thank you.
So thank you very much. Our participant, please use your favorite emoji to thank our panelists for these insightful sections. Is in fact, the conversation is deep, and I love it very well. So one thing I want to also say about this is that this capital infrastructural development conversation will still continue, because relatively, what I have seen in the capital city where we are here, often the government will take the burden. Mr. Vianney says earlier that the function of the government is to provide infrastructure. But the bigger thing we have seen is that the government will back on this burden. They will provide the infrastructure, which will indirectly increase the value of other assets around those regions. Then the private individual will sell at exorbitant prices by benefiting from their investment across that infrastructure, while the government, on the other hand, will be paying for this funding. And we all know that the funding that the government used indirectly comes from the citizen. So a lot of people who are not benefiting from it. So maybe earlier in the year, we will still come back again to go deeper by looking at it from base level on how best to either reposition this infrastructural financing to cater for all citizens instead of some selected investors benefiting from it. I enjoy the sessions because it's an institutional discussion, and we have seen and hear from all the perspective of the experts we have here. As I said earlier, thank you very much. I did not see any question on the comment on the chat box here that we can read. Anybody with any question? Okay, I cannot see any question here. It means that we all understood the discussion. The next thing is now go and apply. I have to specifically thank you, Mr. Kevin and Leila. You have been in this session now for, if I'm not mistaken, for five times, and I recognize the time you have invested in this webinar series, not for anything, but for we to share knowledge, as we said, and collaborate among each other. So thank you very much. We really appreciate that. We appreciate your support towards this initiative. Mr. Vuyani, thank you very much for your time. You are welcome on board. We have these sessions every month, and the conversation is all around real estate, investment, and housing. So we hope to see you once more in this section. So at this point, Halima, over to you. Thank you very much, Mr. Kevin. We will see on WhatsApp.
Yeah, thank you very much, our distinguished speakers and our host, AS Yunusa, and of course, our audience. It seems like none of you have any questions, and I hope you enjoy this session from our speakers and hosts. Hopefully, like the host mentioned earlier on, we hold this program every month, once in a month, and I hope to see you, especially our audience, next section on the 26th of March. So thank you, everyone. Thank you, our speakers. Thank you, Mr. Kevin, Leila, and Mr. Yuvani. Thank you very much for your time. We appreciate it. Have a lovely day.
Thank you.
Now it's networking period. Anybody can network with anybody.
I think Mr. Vianney, I think your microphone is off. We can't hear you. You have to switch it back on. It's still off. I don't know if you can assist.
Let me help to unmute him. Let me help to unmute him.
Okay, now can you hear me?
Yeah, I can hear you. I have unmuted you.
Okay. Yeah, thanks for the invitation. I wasn't really sure what type of audience would be chatting to. I'm also very happy with discussing, especially real estate, because that's my forte. I'm also very happy with discussing infrastructure in this broader sense. I mean, as I have been exposed to some of those, but I mean, I'm more a real estate player than in infrastructure. Fundi, unlike Kevin and I think Leila. But thanks for the invitation, guys.
You are highly welcome. We hope to have you next time on our discussion.
No, definitely happy to participate.
Yes, I believe Halima have your WhatsApp contact. Did Halima have your WhatsApp contact? Halima?
If not, I'll give them to her.
Yes, please. Very important, please. I'll follow you up after the session.
No, fine. Thanks for that.
Yeah, thank you very much. So every other person, thank you until we see you on 26th of March to talk about climate investment.